Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in today's video, I want to look at Terry Smith. Terry Smith's portfolio. Terry Smith is one of those super investors who has his own fund called Fund Smith, and he's performed or outperformed the S&P 500 for so many years in a row. He has basically invested in quality companies, and of course he's got, he's beaten the markets for so many years. And what I want to do today is I want to focus on 5 Sharia compliant companies that are in his portfolio that I genuinely think they're quality, not necessarily cheap right now, but it's one of those things that if you're interested, of course you can add it to your watch list, and then when the price is right, then you can add it to your portfolio. Of course you will have to do your own research and so on. I don't do these kind of videos for me or you to copy his portfolio, because in the end of the day, his philosophy and his base, what he's looking for, is completely different to what we're looking for. Not completely, but it's not, it's not exactly what we're looking for. And you have to be careful with that sort of just blindly following anybody or copying anybody else's portfolio, because his reasons are completely to mine and completely to to yours and so on. So yeah, just to bear in mind when you do that sort of a thing. And the first thing I would like you to do is like the video, because it genuinely helps the channel. And, I'm trying to grow this channel so we can reach out more brothers and sisters, as well as, of course, you can join us in the Patreon account where you get access to all the buys and sells that I'm making normally. You can have access to the dividend trackers. You can have access to the dividend calendar, as well as the private Discord where a lot of brothers are sharing very good practice. Sharia compliant investing ebook as well is there. So you got a lot of things that basically you can, you get your hands on. And basically you're helping the channel. Even if you subscribe for 1 month, and if you find any value in the Discord and everything else, then of course you stay with us. If not, of course you can always change your mind. Now let's have a look at the company. I want to make this video as short as I possibly can. So we're normally looking for all of these things, because I do believe I want to give you a quick summary, and again you're going to have to go away and do your own research, but this is my own summary. So I'm focusing on the how big the company is, the moat around that company, so basically the competitive advantage and so on, the dividend side of things. I'm looking for the return on equity, profit margins. I want to see if they have any free cash flow to cover that dividend, buying back their own shares and so on. I want to see where the company has been in the last 10 years, so total return in the last 10 years, including price as well as the price appreciation as well as the dividends. And then I want to see what the analysts are saying in terms of the next year, next 5 years. Where do they think this company is heading? Because again, that's really important to us. And then I want to see if it's actually valuation wise, is it actually a buy right now. And I genuinely think by having this quick overview, then you can learn more about the business and dig deeper. But these are the things that we're looking for. Now let's have a look at the first company, and the first one is a Stryker Corporation. And this company is a pharmaceutical company. They're very similar to Medtronic, so they sell a lot of the devices that is used in hospitals and so on. It has 117 billion market cap. It has a wide economic moat. Current price is $306. Dividend is lower than 1%. The payout is only 30%. The latest increase was 6.7%. The 5-year growth rate of 10%. They have been increasing that dividend for 31 years, so they are different aristocrat. Annual payout is $3.20, safety of 90%, profit margin of 13%, return on equity 15%. Now they have $2.5 billion of free cash flow, which is quite nice. Total return in the last 10 years is actually excellent, 15%. Next year, they're expecting the earnings to grow by 11%, 11% after that for every single year for the following 5 years, and 34% premium right now, $229 per share is where the price should be. Right now is over $300. Now, this company has been in my radar for a long, long time, but I have not got to the time. I've not seen it undervalued for, I think, good 3 years now. So I'm just going to keep an eye on for now. I'm not going to buy or anything. Just before we move on to Home Depot, I just want to show you in terms of earnings expectations for Stryker. As you can see, 11 double digits for the next 3 years. Again, almost double digits for revenue as well, which is quite nice. Next one is Home Depot, $355 billion, wide economic moat. Current price $354 per share. Dividend above 2%, 13% in terms of the payout ratio, which is very, very low. Latest increase about 10%. 5 year is 16%, which is really nice. Dividend struggle 14 years, which is again really good. Annual payout $8.36 right now. Safety of 87%. Profit margin is good. Return on equity is excellent. Free cash flow absolutely amazing, almost $18 billion. Total return in the last 17 years last 10 years, sorry, 17%, 4% growth this year, next year, and then 2% after that. 36% premium right now, according to Morningstar. $263 per share is where they think the price should be. Now, if we look at Home Depot on Seeking Alpha, in terms of earnings, okay, this year, the 2024, they're expecting a decline. I think that's going to give me an opportunity to hopefully to add to this, and after that should bounce back. In terms of revenue, more or less the same. This is the kind of slow grower, so 2-3% to not 3%. Grows about 3-5%, 6%, 7% every single year. If you go to ratings and we go to some more Wall Street, okay, they're actually saying is a buy, but it's $343 per share, so it's slightly lower than where we're looking at. So wherever you look at right now, it seems a little bit overvalued. Next company he has in his portfolio is Mastercard, and I think he also has Visa. I can't remember, but $402 billion, wide economic moat, 426. Dividend yield of 0.53. I'll show you his entire portfolio in a second. The payout ratio is 19%, 16% increase in the latest increase, 5 year of 18%, which is really good for Mastercard. I always talk about Mastercard, and I feel like I should be buying this company because it's really a high quality business. Oh, by the way, I think in New York, members of the community always ask, how is Mastercard and Visa Sharia compliant? And I always say to you guys, look at it this way. This company doesn't really need to know basically how much a bank is charging for, I don't know, whatever. They create the bank and the technology that allows these banks to transact. So to send a transaction from A to B, the security side of it, what's in the card, all of that stuff, and they get their card from there. So they don't really they're not involved in the riba side of it. If banks decide to give you 10% interest, that's their business. They don't care. They want to make sure that transaction gets to where it needs to be, and so on. So it's a technology company, really. Safety is 99% right now, 444% in terms of profit margin. Return on equity is absolutely amazing. Almost $10 billion of free cash flow. Total return in the last 10 years, we're looking at about 18%. Growth estimate, 17%. Growth estimate for the next 5 years, 20%. Fairly valued right now, $421 per share. And if I show you now, if we go to Seeking Alpha and go to earnings and then show you what the company is expecting, double-digit growth in the next basically few years, which is really nice. And in terms of ratings, as you can see, is a buy. Their buy price here is 463, so that's about 8%, 9% growth from upside from where we are now. Now the next one is Automatic Data Processing, another company that I own in the portfolio. 96 billion market cap, wide economic moat, $232 per share right now. Dividend is over 2%, which is quite nice. Payout ratio is slightly higher than I would like. Latest increase was 12%, 5-year growth rate of 14%, 49 years. So next year this company will become, if they increase, they will become a dividend king. Annual payout, we're looking at $5.60. Safety of 97%. Profit margin 19%. Return on equity, absolutely wonderful. Free cash flow right now, $3.2 billion. Total return of 13%. Next couple of years, 5 years, they're expecting, up to 11% growth, which is really, really good. Fairly valued at the moment, $240 per share. So I might be looking at this company again, thinking, you know what, let me add to it and so on. But I will let you know. As always, I'll let you know. I haven't made a decision whether I'm going to add it because there's a few companies in my portfolio that are still undervalued. So if we go to earnings first and just look at it, so as you can see here, almost double digits for the next 3 years, and then so on for like 5%, 6% growth, which is quite nice. So from $19 billion to $22 billion in about 3-4 years. In terms of ratings, as you can see, is all hold right now. And basically it's got 6% upside, but they're saying is still a hold. But yeah, so this is again great company. I like the business model. I've had this company in my portfolio for a bit, and I'm going to continue doing that. Next one is MSCI. So this is one of the companies that I have not spoken about in this channel. A lot of it because it's always been overvalued, and I like to bring some dividend paying companies that are undervalued a lot. So it's been overvalued for quite some time, just like a Stryker. 43 billion market cap right now. Wide economic moat, $551 per share. Dividend is just 1%, 42% in terms of payout ratio, which is not bad. Look at the 5 years. So the latest increase was 10%. The 5 years, 28%, and 8 years of increase in that dividend. You get $5.52 for every share of this company that you own. And safety is 61%. 61 and above is a safe and very safe, but below 60 is basically it's not unsafe. I can't remember what it's called. Okay, but I think yeah, so it's getting to that territory right now. But then again, when you look at the payout ratio, there shouldn't be any issues there. Profit margin, absolutely amazing. Return on equities, for some reason, is not displaying here. Free cash flow, $1 billion. Total return in 29%, sorry, in the last 10 years, which is absolutely huge. They're expecting the earnings to grow up to 14% in the next 5 years. Right now, 24% premium, $440 per share is where they think the price is at, should be, but look at where it's at now, 552. That's the 5 companies that I wanted to share with you guys. One thing these companies have in common is a lot, basically quality. They have excellent free cash flow. They go in their top line, basically top line and bottom line, as well as, of course, they're giving shareholders a lot of returns, double-digit returns for every single one of these companies. Hence why they probably that's the reason why they're expensive, because all these hedge fund managers, they do their due diligence, they do their research, and they know these are companies that, as you know, if they can expect this sort of a double digits every single year, then of course, apart from this one, it's got double digits every single year for the next 5 years. So that's the kind of thing they want, and that's why they're willing to pay higher premium. Some of these companies have ridiculous PEs, but of course these people do not actually take PE just into consideration, PE only into consideration. There are other things, the PEG ratios and so on, and looking at the free cash flow and free cash flows per share and so on, that they take all of these things into consideration. So let me see MSCI's expectations, and then I will wrap up the video. I'll show you from Sharia compliance side of things. So if we go to earnings first and earnings estimates for the next 4 years, 5 years, you can see it's all double digits. Again, same things for the revenue, really quality business there. But no basic expectation. Remember, these are just estimates. It can easily change. So in terms of thing, it's also 562. So it's about 1% upside from where we are now. Finally, I want to show you from Sharia compliance side of things. You can pause the video, have a look at it. There's no issues really. Basically, the only one that's higher interest bearing debt out of all of them is just 17 with this one, basically Home Depot. Other than that, they are all okay. Now, if you like this type of content, it takes a lot of time and effort to put these videos together, to record it, to edit it, to do all of that. I would really genuinely appreciate if you can just like the videos and let me know if you have any questions. But before we finish, that's the name of the guy. This is the third quarter that basically they reported. So portfolio update, how big the portfolio is and so on. And then you can see here his company. So his portfolio, the percentage, the biggest company he has in his portfolio is Microsoft. He actually sold a little bit of a Stryker. He added to it. And then as you can see here, you got Meta, you got automatic data processing, you got the Visas. I told you he owns Visa as well Mastercard. And Pepsi or PepsiCo, for example, he owns Google, Procter & Gamble, Charge & Dwight, Nike, for example. He owns loads of companies, including Apple, Fortinet, and so on, so. So the list is long, but you can see here he's got my Mastercard in there, McDonald's and J&J's and all Home Depots or whatever. So you can pause the video and have a look at it if you are interested in any of that. As always, I really appreciate all your help, and as much as you know, whatever you can to, if you can join us in the Discord and the Patreon account, that would be absolutely wonderful. Thank you for everything you do for me. I appreciate that. Thank you very much. Have a wonderful day. Assalamu Alaikum.